Hey, all right. Good morning, everybody. So it's Friday. We made it. We have non-farm payrolls this morning. It's pretty much all we need to get through, and then we are good to go. Really, that's the biggest threat for today. We have the opportunity for a liquidity gap candle, and then we have the president this afternoon. It looks like we could see something. Could possibly get something from the Supreme Court on the tariffs. So what we're reading right here, why it's got a high risk based on current schedule, says the high profile on-camera meeting with oil and gas executives amid the energy and climate sensitivities plus presidential travel to Mar-a-Lago introduces moderate risk of political backlash and market-focused speculation. So not necessarily an event, more of just the opportunity for risk. The Dow basically flat, S&P really right behind it. Then the Nasdaq, small caps leading the way. It's that dichotomy again where we see the small caps performing better than other things in the overnight and then most likely falling back again once we get into the open. So keep your eye on that. Look for the small caps to stall out. They don't necessarily have to fall per se. They could just stall and then the Nasdaq could overtake them and be the dominant one today. Everything rests on the non-farm payrolls. Because of those, it's going to go directly to the heart of what we're going to see here with the Fed and their potential for a rate cut or a rate pause, and whether the market is going to price in that cut or not. Pricing in a cut should be very bullish. It would just explode us to the upside. That would be the base case argument. But that gets us back into the proportions of bad news is good news, because bad news would mean it's going to force a cut. It's like hoping to get a hurricane so you can collect on your house insurance. It's a doesn't make much sense, but that's the way the market works, right? High unemployment numbers, bad news gives them hope for a rate cut, and then the market goes up because of it. So therein lies the crazy logic that we trade in. This little speech this afternoon by Barkin, it shouldn't be impactful. Just watch the clock on this one. Hopefully, between now and then, we'll find out if it's going to be prepared remarks or, if he submitted his response via videotape or something like that, or whether or not there's even going to be Q&A afterwards. Eliminate Q&A and have a fixed report. You can oftentimes just ignore the event with the understanding that it's very likely not going to cause any volatility. I don't see any reason for him to, start throwing shade around and rocking the boat. Well, all things considered, this hurry up and wait week hasn't delivered all that much, but we did stay within the boundaries of the weekly expected move. No, I'm still here. I just wasn't speaking because I was reading. I can't chew bubble gum and walk. I was thinking that there was something else to go over, but it's not in the this list, so I guess we don't have to go over it. Very likely by Monday it's going to become a thing, and then we'll have to go over it. We'll just deal with things one thing at a time, right? All right, overnight volume 44,000. It's a little light. It's not that bad. Little light. Um, there was some good questions about the volume yesterday and whether or not you could use this same tactic on other products, and you absolutely could. The thing is, when I started using this lower indicator, I didn't make this indicator, by the way. I mean, sure, this is a custom one, but I just copied one that was already there and added my own little labels to it. So this isn't something unique. The volume is just getting counted after midnight, and every new trade that comes in, it gets added to the list. And so it's just cumulative overnight volume, right? So I was looking for a way to gauge market participation in the overnight hours on this particular product because I tend to trade this product more than anything else. And if there was a lack of participation, then it would warn me when I was a newer trader that there was something that maybe I need to go back and look for, something in the news, something that could be coming that I didn't see. I've been doing this for a while, so I've got a pretty good feel for events that are coming at us. But when I was newer to trading, it seemed like surprise events would catch me off guard all the time. Not things like non-farm payroll, but maybe QRA or some big AI investor conference or something like that. Something that wasn't necessarily on the docket that was just easy to see or easy to find. And this volume or lack of volume would oftentimes be that heads up that tells me, hey, you missed something. Go back and look deeper in the news because they're sitting out, they're not participating. Now, I've been using this same chart setup for years, looking at this every single day. So I know what it looks like when things are off. I know what it looks like when things are acting normal or we're above average trading. And this to me was also another way to spot if maybe a nation hadn't come in to participate because I'm just a typical lazy American. I only pay attention to my holidays, not Canada's holidays or Japan's holidays, China's holidays. So, rather than doing a deep dive every week to see who's got bank holidays, who's going to be closed, did a market open somewhere in the world, I can just look at this every day. If the volumes are really light, then I know I missed something. Maybe a market didn't open, right? Like maybe China took the week off, or maybe there's a big event and they're scared. Whatever it is, the light volume tells me to go look and figure out what did I miss. Could you use it on something else? Sure. But then you're going to need a baseline for what does normal look like. I know what normal looks like here. I've been staring at these charts for years. If you wanted to apply it to gold, copper, oil, whatever, you're going to need a baseline for what does normal look like, and then what does light participation look like, and then what does heavy participation look like. So it's just finding familiarity with the product that you're trading. This says it's a little light. but that makes sense because we have non-farm payrolls. We didn't miss anything. We know why it's light, so there's nothing to worry about. We still got a really clear distance between the 3 and the 10 and the 10 and the 20. We haven't lost that structure. It's more of this fork shape when we come out here on the daily. This fork pattern is about as healthy as it gets in the moving averages, right? That's what you want to see. It would be better, right, if the fork was a little more pointed to the upside. This one seems, like it's a little flatter, not so aggressive to the upside, but the distance between them is really good. We did dabble down below that 3 cross the 10, but if we want to see a 310 cross, we're going to need price to get completely below the 10 and then go deep enough underneath to drag the 3 through it, like it happened back here. We were doing really well. The fork was there. We had a nice spread. Price cut deeply through the 10, and it dragged the 3 through the 10. And then, of course, we came back out of it. That 310 cross is where we get the bear surge and the bull surge, right? It's the logic behind it. So we're testing that bottom side, see if we can get another dip below the 10. The problem or the concern is the idea that we keep dabbing that area, we could absorb whatever's down there structurally and then drop through it. So 69.32 cog line, it's basically the 20 period daily moving average. Cut the 20, we go to the 50. It's simple enough, right? There's some speed bumps in the way. 69.11 cog line, 6900, 68.92, and then you get the 50 moving average. We did get our higher high. Now we're just trying to resolve, are we going to get this higher low, or are we going to end up with a lower low? Well, to get that lower low, we've got a long ways to go, right? We'd have to go all the way down here and break that, and then, go lower, and then still come back up again. Then we would have a lower low. Right now, after setting this higher high, we can't count this as our high or low. We can't count that yet because we're still sitting inside of it. We need to leave this candle behind. We are inside day. Technically, we're IX10. We're just IX10 inside of a big range. And we need to GTFO. So when we get out of the box, then it's game on. The control bar at the moment is right there. It would be this day, January 6th. That's the control bar. Just move that over so we can see the wicks. Now, if we're thinking about reciprocation, this little wick above, we could get wick below, right? That would make sense because that would be like a 111 or a 1236 on the bottom. That would allow us to test the 20, stretch underneath it just a little bit, kind of like we did back here when we got underneath the 20 and came back up again. But this is the box. This is what we got to get out of. So it's what we want to focus on. GTFO, right? Get out of the box. So simple enough. We get out to the upside, we got room, and get out to the downside, we got the levels down here to focus on. Doesn't really matter which way it goes. We've got a plan in place. Now, inevitably, every day somebody says, well, which direction do you think it's going to go? I don't really care to speculate. If we had a signal that told us it was going to go down, I would tell you there's a signal, it looks like it's going down. And if there was a signal that says it looks like it's going up, well, then I would tell you there's a signal, it looks like it's going up. If there's nothing there, then my guess is as good as your guess, and you might as well just flip quarters or go to Vegas and get free drinks while you gamble. I don't care to speculate. I'll just sit back and wait for it to break, and whatever direction it does break, that's the direction that it will play it. Or play the breaks reversal, right? I don't care. I don't have to guess. If that's your trade style, is to sit there and guess, even though you don't have any solid evidence one way or the other that it's going to break to the upside or the downside, then you do you. If there's nothing there, there's nothing there. We have a market maker move today. That tells us that they're adding additional hedges in the front end. Now, they're always hedged, always. They don't trade naked. This is additional hedges. There is a binary event front and center today within the next few hours that has them concerned enough that they are buying additional hedges. Now, you and me, we can hedge, and it's basically just a trade. I see it all the time. Somebody wants a quote, I want a hedge, and they're basically just trying to make money if the market goes down. Well, you can call it a hedge or you can call it pancakes, but it's not a hedge, right? You're just trying to make money if the market goes down. That's not a hedge. And since it is just a trade, you can usually minimize your risk, and a lot of times you can make a little bit of money or at least break even. Not with a real hedge. With a real hedge, it's just cost. Like starting a fire and just throwing money in it. Cost. Paying for your insurance. They don't give you a kickback just because, you didn't get a house fire. You pay homeowners insurance for a house fire, you just lose your money if you don't get a fire. These guys are spending money to hedge this morning, and this isn't my opinion. I'm not speculating that I think they're hedging. I'm telling you, they're hedging. We know that they're hedging because we can see it right here. Market maker move. Now, market maker move is a think or swim thing. It was made up. Literally, they just pulled it out of thin air. They made it up, but it's been around for so long that it's become pretty much the norm, right? And the idea behind this is that even though your broker may not have it, your broker can still show you if there is a market maker move. What we're doing is looking at the front end of the expiring options, the ones that are 0-day today, and we're comparing that to the next options series out. In this case, it would be the ones that are going to expire on Monday. If the 0-day options have a higher implied volatility average than the next series out, then you have a market maker move. That's it. It's as simple as that. Why is it so simple? Well, they don't give us all the answers for how the math is done, but the implied volatility that we see within the options chain on every one of these strikes, this implied volatility changes depending on how fast a particular trade comes in on that strike and how often and then what size that trade is. That's some of the math behind it. So they use all of the out of the money options on the call side and all the out of the money options on the put side, and they average that to get us this number up here. And then they run it through a square root formula with time and then a couple of other proprietary things that is secret they won't tell us, and they get that number. So if a firm comes in and starts trading really heavy in the pre-market on these out of the money calls and out of the money puts, it jacks up the implied vol on the front end. And that heavy out of the money trading early in the morning is the signal that they're hedging. If you want to know more about this, you can go to Google, type in market maker move. You'll see some articles by Schwab, since they own this now. If you could use the go back, the internet go back to when TD Ameritrade owned it. They had 25, 27 articles on this thing. Fantastic writings that talked about the math and just all sorts of really great stuff. But once Schwab bought it, they condensed all of those articles into like 2. So you can learn about it, but really they threw out a lot of really rich material. And none of those articles talk about the futures. They all talk about equities and basically earnings announcements or binary events like M&A deals and things like that. But that's the market maker move. So we can see that we have a market maker move this morning. That's our signal that they are hedging. They are concerned enough about this binary event that we could get a big move, which says that we could get a liquidity gap play. I've covered the liquidity gap often enough. I wasn't set up to show it again today, but the idea is it's going to be very likely a big bar. The way that I like to play these outsized bars is wherever the bar started, that's where we got to go back to get the gap closed. I don't want big wicks on each side. If it's a red bar, I don't want a wick on the top. If it's a green bar, I don't want a wick on the bottom. The gap usually gets closed around 10:30, 11 o'clock. So, got a couple of hours before it gets done. And the main warning is if we get a big bar to the upside, for an example, that we could fall back down, not stay bullish, and, get the gap closed. Or if it's a red candle and we fall hard and fast, that we could turn around and go back up because we got to get the gap closed. I got plenty of examples that I've shown again and again and again. On big event days like non-farm payrolls, you have this opportunity to identify a lightning strike, so to speak. At 8:30, we're going to get the data. We very likely are going to get the candle. I use a 5-minute candle for this. Let the candle come in, let it close, mark it from the top and the bottom and the mid, and you're good to go, right? Simple enough. This is the hurry up and wait that we've been waiting for all week. So now we just need to get it, which means anything that might be up or might be down doesn't matter because we got to get the non-farm payrolls data, and then we'll see what the market wants to do after that. Today's floor pivot is lower than yesterday. That's bearish. Price opened above it. That's bullish. We've already interacted with it, so that's done. You could argue about the missed daily pivot from yesterday. I know it shows that we hit it, but I'm calling it as a missed daily pivot. So that's the first missed daily pivot. If we were looking for consecutives, then we would look for today to be another one, but we've already hit ours today. So that's kind of off the table. We stayed all day underneath that floor pivot, by the way, right? The entire day was spent underneath there. Now today we're on the floor pivot, we're fighting with it, and this is the first down day of the pivot process, right? We've been tracking these for a couple of days. I've been pointing out how they were climbing higher and higher and higher. Now we're rolling over. This is the first one. So what happens today is really going to set the tone for where we go from here. And it's that same IX10 that we've already talked about, right? That we're inside day, we're stuck inside this range. And we need to resolve that one candle. Now you notice you can't see the floor pivot anymore. Today's floor pivot is the midpoint of that boss bar that I mentioned a little while ago. Candle of control. So today, if we stay above that floor pivot, we have an opportunity to continue to rally. If we break below that floor pivot, then we've got an opportunity to break this and head to the downside. Next Friday is OPEX. We should still have enough structure around us, optionally speaking, that we don't run too far if we do get a breakout or a breakdown. But that doesn't mean they couldn't use the event to go ahead and begin to roll, right? They're going to be moving their positions next week anyways. They could just start doing it a little bit sooner. So that's something to be mindful of today after the 9:30 data, 8:30 data, is are they going to start unwinding their positions for next week's roll early, like today? All right, the R1 is outside of yesterday's range, but S1 is within the range. And it's got a really clear signal that upside is more likely than downside. That does not mean that price is going to go up rather than going down, right? These lines don't make price do anything. But you can see the distance between the floor pivot and R1 is much greater than the distance between the floor pivot and S1, which is not as wide, right? That line's farther away than this line is. That's the indicator saying it's more likely that we go up than down. But this indicator doesn't make price do anything. It's just math, right? It's just math. If we do get another shot at the upside, 69.90 or 69.92 cog line has that speed bump, and then it thins out really well as we get close to the high. So just above 7,000, we start running into a lack of oxygen. Thin air up there. It's more likely that we reject across that high volume node anyways, but keep an eye on it. If we can get above it, it could act as a stabilizing force once we're through it. Otherwise, we got a lot of structure that we've been working our way out of, and we would need to get below 69.32 cog line to really get outside of all of this junk. $68.92 is, it seems like a long ways off, but outside of that value area, that's the target, right? 68.92. 10-day, 30-minute volume profile and TPO. We're still looking to see which way the wind is going to blow here, but it's very likely that the current point of control doesn't move for the rest of this week and very likely into some of next week. We're still looking for the new boss, the new dominant position. And until we even start to wipe out the candles that made the current point of control, we would have to sit in a new position somewhere long enough to move it. Today was supposed to be a hurry up and wait week, right? The whole week was supposed to be a hurry up and wait week, which would have been an easy way to move the point of control. We could just sit in a 30-point range, build out a lot of volume, and get the point of control to move. And that's not what we got, right? We've been expanding all week with that silly grind to the upside, and then we started giving it all back halfway through the week because we reached the edge of the weekly expected move. So we're not looking to see this point of control move at least into next week. And that's going to be, getting us focused on OPEX and the opportunity to see it move up over our head, 68.92 cog line. It's really the only spot that it could go to at this point, right? Either one of these two, because there's nothing down here. We would have to put a lot more work in for that to be the new home. All right, the VPOC that we identified yesterday is still in place. We don't have a new one because if you look at where we would put it, we've been running back and forth through there all night long. Yesterday is a really tight range. And right now we're inside of it. So we just got to get out of this, right? It really is just as simple as that. All right, now we have a preview of next week's range. This preview is not yet set in stone. It's going to move all day today. The gray line is where current price is, and the red and green lines are moving up and down as price moves. So this whole box is just shifting up and down. How wide or how narrow it gets is based on the options trading activity in next week's range, right? So this one right here, Jan 16, 107.40. That's the plus or minus, right? So as that number moves up and down, the width of that chart is going to continue to expand and contract. After the close today, around 4:30 or so, it'll lock into place, and then that's it. That's done. There's multiple expected move models that we can use. This is one that stays locked in place. It's a static expected move. There's another one that changes every single day as every minute goes by. That's a dynamic expected move. Still a weekly, though, for both of those. And then you have a daily expected move. Expected move can be calculated and formulated for anything. We're specifically focused on the locked in place dynamic is not for this, right? You want to use the dynamic after the new week starts. So this is our range. One of the things that we can do with it is compare it to the range that we just had. We can see if it's smaller, if it's larger. We can compare that with notes against, hey, what kind of events do we have next week? And it's kind of tricky, but if you think about things like non-farm payrolls, FOMC, CPI, PPI, you would think those are big volatility events and that the box would be really wide. But those are volatility suppressing events, and it makes the box really narrow. So if we had known unknowns on the docket for next week that was really upsetting people, we would have a very narrow range because they would be pricing in another hurry up and wait week. But next week's range isn't really narrow at all. It's a little wider than the current week that we just had, and the current week is a week that was waiting on big data, non-farm payrolls. So hopefully by the end of the day, maybe even into Monday when we come back and look at this, maybe the box will have shrunk considerably or it will have widened out considerably, and we'll have a better idea of what to expect in the new week. Oh, the thing about the market maker move on OPEX week, especially triple witching OPEX week, it'll present false flags. So, if you've never heard of it before and you're just now hearing about it and you're thinking that, oh, that's fantastic, and you're going to run out and use it next week, be careful. Next week is OPEX week, and it can send you false flags because they may be rolling out of those out of the money options, and that can trigger a market maker move, even though there really isn't one, right? It just looks like there is one. Our distance from the 10-day is fine. Everything still seems good here. And our distance from the 10-week is fine, right? And that shouldn't be a surprise. We haven't done anything. So our distance from the MAs shouldn't have changed either. We're on wait, guys. We need to get the data and see what the market decides it wants to do with it, whether it's going to use it as the excuse to begin to unwind what they've priced in here, or what are they going to do? That's what we need to find out. So watch the clock and be careful, be safe. I'll see you guys next week.